Good afternoon, RGEA members and guests. Welcome to today's webinar, Pensions Protection and Public Trust. Our speaker for today is Brad Briner, Treasurer for North Carolina. I'm Tim O'Connell, the Executive Director of RGEA, and I'm grateful to have so many RGEA members joining us for this webinar today. We appreciate your choosing to be a member of RGEA. We are collectively 60,000 plus members, and each of you contributes to making our voice stronger and more representative of all those retired from public service. I'm thankful to have RGEA's community liaison, Daryl Davis-Fulmer, also joining me today. Our fantastic Lunch and Learns webinar series would not be the success they are without her strong relationships with so many of our key partners and members. I also want to thank our very capable colleague, Tracy Eubanks, for her technical support today. Last but not least, I wish to express our gratitude to Treasurer Briner's team for their support in endeavors such as this. As an organization that values and believes in public service, RGEA appreciates the level of professionalism and the proactive communication they provide us regarding matters that impact our members. Before we begin this webinar, I have a few items to cover. First, each of you has been muted to ensure that our presenter can be heard. This presentation is being recorded, and we will send you the link to the recording along with the PowerPoint and a follow-up email. For those of you who send questions in with your registrations, we will be submitting them. We have submitted them to Treasurer Briner's office, and many are already incorporated in today's presentation. If you think of a question during the presentation, please use the Q&A button. That's the Q&A button at the bottom of the Zoom page. The team will respond to the questions as they come in during the Q&A period. Now to share a little bit about our speaker, Treasurer Brad Briner, and this is a true pleasure. Treasurer Briner was sworn in January 1st, 2025. Prior, he was the co-chief investment officer for Willett Advisors, where he advised Michael Bloomberg's investments, which are quite large. Before Willett, Brad held positions at Morgan Creek Capital, the UNC Management Company, ArcLight Capital, and Goldman Sachs. Mr. Briner graduated from the University of North Carolina at Chapel Hill, and I know he's a proud Tar Heel. He was also a Moorhead Scholar, a very coveted scholarship. And after his time at UNC, he went to Harvard and received an MBA with distinction from the Harvard Business School. He currently serves on the Board of Trustees and the chairman of the Investment Committee for the Phillips Exeter Academy, and formerly served on the Board of Trustees for the University of North Carolina at Chapel Hill, the Board of Directors of the Boston Omaha Corporation, and the Debt Affordability Advisory Committee for the state of North Carolina. Treasurer Briner and his wife reside in Chapel Hill with their 4 children, and it is an honor to have him with us today. Treasurer Briner?
Hello, can you hear me?
Yes, we can.
Yes,
Okay.
yes is the answer.
We literally reconnected about 10 seconds ago. So
okay.
I'm gonna thank you for an introduction I didn't hear.
It was excellent. From what I hear, it was excellent. Yes.
So we are still working on getting the slides back up. All right. Looks like we're in good shape. Okay. Thank you, everybody. I appreciate the time, and thank you for rolling with us technologically. Microsoft and Zoom are not best of friends, but we are making them cooperate today. It is a pleasure to be with you today, and I wanted to begin by telling you a little bit about myself. I know Tim gave a wonderful introduction, and a presentation wouldn't be complete without embarrassing photos of me and my family, so here we are. My parents, as you see in the middle there, had 4 children. I'm the youngest of those 4 children. We grew up in Dallas, Texas. You can see by my father's glasses, this photo was taken in the early 80s, maybe the late 70s. And in the early 80s, we had the unfortunate incident where my father lost his job. And for me, that was a defining moment in how I think about family financial security and what animates me every day. And so I always put that out front because it describes a lot of what I'm doing and how I think about things. On the far right, you'll see my family today. My wife and I met at Chapel Hill, and We have 4 children, the oldest of whom is headed to Chapel Hill. So we've done a wonderful job of brainwashing her as well, working on the next 3 too. Out of UNC, took a job managing money, as you heard. It's really what has animated me for the entirety of my life. And after spending a bunch of time in New York managing money for one of the richest people in the world, I had the opportunity to run for treasurer in 2023. And the reason that that was interesting to me is partly an experience I had in 2021, where I walked into my boss's office, and 2021 was one of those years that you have in capital markets where everything just goes up and everybody looks smart who's invested in anything. And so it wasn't that we were uniquely capable that year, but it was one of those uniquely good years. And I told him how much money we had made him. And after waiting a second for his response, I'd hoped for attaboy at the very least, and maybe something more than that so I could share it with my team. I got the equivalent of, what am I going to do with all that money? And for me, that set me on a path of thinking whether I was using my skills for their highest and best use. And that made it easy to run for treasurer in 2023. We'll talk about a number of the pieces of what we do here, and you're familiar with many of them already. But the investment side is near and dear to my heart, and that is something that I think we can improve on tremendously. So took office January 1st and have a lot going on here at the Department of State Treasurer. And so I want to walk you through some of that at a high level and some of that in some significant detail. We have 7 major divisions here at DST. One of them is very new. The other 6 have been around for quite a while. And all of them have the common theme of touching the treasurer of the state. So the treasurer of the state is not just our assets. In some cases, it's the money we owe as well. And so that defines everything we do. The newest division you'll see up on the screen. In December of 2024, a Hurricane Helene-related cash flow lending program was created. Initially allocated $100 million by the General Assembly. The goal was to provide cash flow relief to towns and municipalities in the affected regions in the western part of our state. That was to be $100 million, and we were given those instructions in mid-December. We had never done this before. We set up a lending program, hired a team, and have begun to issue those loans. The first of those loans went out within about 8 weeks, an effort we're very proud of. The second round of those loans is going out in the next couple weeks, and we've been able to allocate over $50 million so far to municipalities who really need those monies. So proud of that effort. And I would expect that this division will grow as other challenges arise for their state in different ways. The next division, which is hopefully the most fun one, and the one that I hope that all of you are already aware of, is unclaimed property. We have something like 20 million pieces of unclaimed property in our unclaimed property division. And many of those are small, but some of them are very large. We run a website called nccash.com where we have a listing of all of those. And so if you haven't searched for your name, your family's name, your school's name, your church's name, everybody, I hope you'll do that while you're listening to me so that we can reunite you with some of your property. There's over $1 billion waiting to be claimed by North Carolinians. We think 1 in 7 folks have money there. And if you have checked before and you haven't checked recently, check again. We get property in every day. And would love to send it back to you. Again, the funnest part of what we do. The next division is the Financial Operations Division. This is essentially the bank for the state. So we have accounts and make transfers daily on behalf of all different entities related to government in our state. There's over 10,000 transactions a day and many billions of dollars held. We manage the cash for this separately. We'll come to that when we talk about the Investment Management Division. But this division, FOD, makes the financial operations of the state work, and something that's critical and hopefully you never hear about because it works seamlessly. One that many of you will know from your time in local government is the State and Local Government Finance Division. We've actually just recently hired a new director of this division. She'll start in a couple weeks in East Canada. She joins from the Association of County Commissioners. The job of the State and Local Government Division is to make sure that our 1,100 municipalities and counties throughout the state are well run financially and are able to borrow in debt capital markets successfully. So we host a meeting once a month called the Local Government Commission. which approves all bond issues throughout the state. This was created during the Great Depression to ensure that we never had a system-wide or statewide financial management challenge like we did back then. And it's done a fantastic job through the last 90 years of doing just that. Now we'll get to the big and more complicated ones. The state health plan, many of you are familiar with, serves over 750,000 current and former state employees and their dependents. This division provides healthcare insurance for all of those, both actives and retirees. We'll talk about some of the changes that are coming for the state health plan in a couple slides, but it's one that suffers from the same challenge that everybody else who buys healthcare has, and that's that prices continue to rise faster than incomes. And so that's a challenge that we are meeting and managing, and I'm excited to give you some updates on what we're doing there. Retirement systems administer the benefits for many of you and sends out checks each month. And we actually do send out physical checks, but most of them, thankfully, are electronically now. We also administer the supplemental retirement programs, the 401k and 457 programs, in addition to the ABLE program as well. So a lot going on the retirement system side. But that brings me to the next division, which is the investment management division. The investment management division is separate from the retirement systems division in that it manages the investments of those divisions, not only the long-term pension fund investments, which we'll talk about in some detail, but also the cash management program. There's over $40 billion in cash that is managed through our investment management division in the short-term investment fund, which has performed exceptionally well over a long period of time. So that's a quick tour of the main divisions, but I want to talk today about the financial literacy efforts that we have underway here at the Department of State Treasurer. In addition to my upbringing and the relevance and importance of financial literacy in what we do, we'll talk a lot about fraud, unexpected life events, et cetera, which is really an integral part of financial literacy. Financial literacy is relevant to everybody, no matter your level of sophistication. Finance continues to evolve. There are new ways to make and to lose money that come every day. And so staying up to speed and staying vigilant and aware is essential in everything you do here. We've launched a newsletter, Finance Fridays, and that will come out this Friday. Each month has a topic. Each month has a guest columnist, in addition to book recommendations and things that I do to support that. This month, the topic is compound interest. As they say, compound interest is the eighth wonder of the world, and those who understand it are destined to receive it, and those who don't are doomed to pay it. So we're going to talk a lot about compound interest and what that means for everybody in the newsletter that will be released this Friday. So I want to dive a little bit further into budgeting, fraud, and scams because these are essential issues. As you saw on the first slide, I have parents who are quite a bit older than just about anyone on this call. My dad is about to turn 95 and my mom is about to turn 91. And so these issues are personal for me and certainly things that me and my brothers are involved in daily. So let's begin with talking about unexpected life events. I think many of you are very well aware of things that can and do happen to many of the folks in the pension and the state health systems here. But the first question for you is control. Who has the ability to help you with that control? How can you help your family members help you in the long period of time? And this is where certainly you want to get with an attorney to make sure that you have the appropriate powers of attorney in place and that your family can help you if and when you have a problem. The other piece of that is the second bullet point here, and a really important one, just ease of use. The more you can automate direct deposits and payments, the better it is for you, the better it is for everybody. And to make sure that it is secure, that those payments and those receipts of payments are consistent and go into the right accounts each and every month. Do you have a durable power of attorney? Do you have a healthcare power of attorney? And in those powers of attorneys, do you not just have a single designee? Do you have a contingent designee as well? Many people will designate their spouse, appropriately so, as the first power of attorney. and do not have a contingent one, and you will need that in the fullness of time. The other things are, do you have reserves and do you have capabilities to weather through whether they may be health problems or actual natural disasters? As we talked about earlier, we've had a series of natural disasters in the state, Helene being the most recent. Unfortunately, there will be more in the future. And are you ready for that? Financially, physically, etc. We want to make sure that everyone has a plan for all these unexpected life events. Scams, and this is a big one. The numbers are just staggering. Over $1.1 billion last year alone was stolen from people in their 60s through fraud. In their 70s, that number jumps to $20,000 per successful investment scam. The advice here on the bottom is so essential and basic, but I need to repeat it. People who are reaching out to you who you do not know, be very hesitant to respond to. If someone sends you instructions to pay something or to tell you that your bill is overdue, do not respond. They will follow up. If it's a financial institution that you know, go directly to their website and make sure that, in fact, it came from them. Technology continues to evolve, and one of the ways that it evolves fastest is in the ways that scammers use it. So if you're getting a text message that you did not expect, if you're getting a phone call you did not expect, or an email you did not expect, the first reaction should be skepticism, always. And make sure that you understand that there are many different ways to spoof things. And the best defense against this is to reach directly out to whomever you think sent it to you. So if it's your bank, don't respond to the email. Go to your bank, go to the bank's website, and they'll be able to help you. Here's some other examples of different types of scams that people have seen. Home repair. People asking for payment in advance of services is a routine flag of different scams that happen. Be careful to ever pay a bill in advance. Make sure that you are receiving those services that you need before you pay for any kind of home repair. Romance scams, and these happen more often than you'd ever believe, where ultimately people are playing a very long game to try to establish trust with you so that they can eventually ask you for money. The broader concern is just be careful with people you don't know. If you have questions, ask your family, ask your friends, ask your neighbors, ask someone at church. People are more than happy to help. As the world gets more complicated, these scams will get more sophisticated, but what will always be true is that in-person relationships with people you trust will help you through them. So moving on to the state health plan. When we took office in January 1st, we knew that we had a big challenge ahead of us in the state health plan. $500 million shortfall in 2026 and another $800 million on top of that in 2027. And there's a handful of reasons why we're in this situation. The first is the basic one, and I touched on this earlier. That is that medical and pharmaceutical costs continue to escalate faster than just about any other cost in your life. As we have not changed premiums, benefits over time, the impact of that is that we couldn't keep up with the increasing medical and pharmaceutical trend. We were using reserves to plug the hole. We were out of those reserves. The other consequence of the clear pricing project was to exacerbate this cost trend. What CPP did was admirable. It attempted to make prices very clear at 160% of Medicare. Unfortunately, in the execution, it was flawed in that it was an opt-in program. So in other words, we went to providers and said, would you like to receive a payment that is equivalent to 160% of the Medicare reimbursement for whatever service you provide? The predictable then happened, and that is those providers who were receiving less than 160% as a reimbursement opted in, and those providers who were receiving more than 160% already decided not to opt in. And so while noble in intent, the consequence was over $100 million in incremental cost for the state health plan. So those are all the reasons that we got here. I think the next challenge is how are we going to go forward? And so you'll see on the next slide the answers to that question. The first answer was on the revenue side. We had to address how much funding we were getting in the plan. And then over time, we'll address what kind of expenses we can pay and how to change some of the incentives that are embedded in the healthcare system. You will have seen a lot of press at this point around benefit design changes and premium changes in the state health plan. We started thinking that we were going to have to charge $20 per member per month of active employees more than we currently do, starting in January 2026. Today, thanks to Tom, Beth, and their team and their efforts, we think that number is only $5. But there's a lot of work to go to make sure that this is sustainable in the long term. And those are the next two bullet points to the right. We got to make sure that we're not in this situation again. And the way we're going to do that is by empowering long-term health. So how do we make sure we're not in this situation again? Set up incentive systems with providers where they can make more if they do better for our members, and our members will pay less if they're able to access the best price for the plan. What does that all mean? That means stable, sustainable relationships with providers that pay them more to take care of state health plan employees, that drive our members to choose them because they're high quality. And ultimately, those all have the effect of lowering price for the state health plan. It's a win-win-win design architecture that we've got to put in place. It's complicated to do so. And so that's why it's long-term. We're in the process of doing that. And we expect that by late 2025 and into 2026, you'll see some material changes in the way that people procure healthcare. One of the other changes that you should be aware of specifically for Medicare Advantage for 2026 is that we anticipate having 2 identification cards and 2 enrollments for members. There will be one for medical and one for pharmaceutical. And so that will manifest in having 2 different cards in your wallet. We will communicate a tremendous amount about this in the fall. This is not until January 1st of 2026, so let me repeat that. And you may ask why. Why do we need to carry 2 cards instead of 1? It's because it's worth $70 million in federal subsidies if we do it this way. And that allows us to keep benefit design essentially the same, to keep premiums the same, and make everything more affordable for our members. So we think that this is worth it, but it will be a communication that we'll go into in great detail in the fall. And so be ready for that. These are the benefit design changes, and there's only one in Medicare Advantage, and that is that the out-of-pocket maximum for pharmacy goes up by 5%. Everything else remains the same, something that I'm proud of the team for getting done. For the 70/30 plan, there are material changes, and these mirror the changes that are going to be put in place in the active employee plan. I think the most important piece is down on the bottom. The actuaries calculate the total value of these plans as a percentage of what is paid. And so when you hear a 70/30 plan or you hear an 80/20 plan, what that's supposed to mean is that 70% is paid by the employer, 30% by the employee, or 80/20, 80% by the employer, 20% by the employee. Actuarial value calculates that number. And so our 70/30 plan in Medicare is actually over a 90% plan. So it's a very good benefit for all those here. That number goes down a little bit. It's still well in excess of 70/30 in 2026, again, mirroring what's happening with the active employees. So for healthcare, to sum it up, Medicare Advantage, very, very little is changing. You will see 2 benefit cards come ultimately in the fall for beginning January 1st. We'll talk at length about that in the fall, and so you'll hear a tremendous amount of communication, and you will expect that. And then for the 70/30 plan, changes will be made as I showed on the prior slide. So moving on to the Retirement Systems Division, we administer benefits for everybody, not just in the defined benefit plan, but also in the supplemental plans, the 401k and the 457. Importantly, though, and I know there are questions on this, and I'm happy to talk about it in some detail, the Retirement Systems Division does not determine cost of living adjustments. We administer the benefits. We make recommendations around both actuarial assumptions as well as the funding required from the employer. but we do not determine cost of living adjustments. For the teachers plan, that is done by the General Assembly. The teachers' retirement system is 88.3% funded. So I'm often asked, why have there not been cost of living adjustments of substance? And the answer is that teachers is not fully funded. And so the General Assembly has historically been focused on getting funding into the plan to grow that 88% to ensure that the plan is fully funded before adding to the cost of living side. But again, that is a General Assembly purview and one that we support whatever they want to do. LGERs is 86.9% funded, so slightly less funded than TSERS. The cost of living adjustments there sit with the LGERs Board of Trustees. They make the decision on what is appropriate there each year, similar to what the General Assembly does for TSERS. So that is the local government employees system. Again, been focused on getting the 86.9% to a higher number rather than on adding cost of living adjustments over time. So just to give you some statistics on the total retirement system this year versus last year. In May, we had 884 new retirees this year, a total of 372,930 benefit recipients, paid over $640 million in benefits. And you'll see that those are all modest increases year over year from last year, going up about 5% across the board for each of these metrics. But we do send out over $7 billion a year in total pension payments throughout the state of North Carolina and beyond our borders. So we'll talk about the seasonality of the retirement systems division here in a second, but the numbers are really amazing. And I'm very proud of our team for being able to handle all of the requests that we get over time. We expect about 3,000 retirements for July 1st. The most common retirement date is July 1st. December 31st, I believe, is right after that. There are over 480,000 people contributing into the retirement systems, and just a little bit less than 340,000 receiving out, and then the beneficiaries on top of that. So moving on to the investment management division, just to talk about the Investment Modernization Act, and something that we've spent a lot of time and effort on in this department, working on over the course of the last year, even before we took office. North Carolina's pension system has been extremely conservatively managed, and we are a conservative state, so that's something that we don't want to lose sight of. But there is such a thing as too conservative. The analogy that I always use is about my two daughters, and I was with them this weekend, and they give me a hard time every time I use this analogy, but it's my privilege as their father. When I was teaching the oldest one to drive, and she'd get on the highway, she would always go 85 miles an hour, and everybody understands that that's a big problem, particularly for a 15-year-old learning to drive. My second child was exactly the opposite, though. She'd get on the freeway and go 45 miles an hour. And 45 miles an hour is a problem in a different way. And so it is with making investments. To the extent that you are taking too little risk, what happens is exactly what we've seen. Inflation catches up with you. Inflation passes you. And you're not able to keep up with that or through a cost of living adjustment mechanism for your retirees as a result. So we've been focused on making sure that the investments are prudently managed and making changes to governance to ensure that they stay prudently managed in the fullness of time. The Investment Modernization Act passed the House 112-3. It passed the Senate 40-0. We expect it to go back to the House for a small concurrence this week and then end up on the governor's desk in the next couple of weeks. What does it do? We have a governance model today called sole fiduciary, which means that I, as the treasurer, have the capability to make any investment I want within some statutory limitations at any time. So it's no exaggeration to tell you, if I walked down the hall to our trading desk, we could buy $10 billion of a single stock this afternoon. That is not best-in-class governance. It's a governance architecture that was put in place several hundred years ago in the first pension systems, and all 50 states at one point had it. Only 3 still have it. So we will be the 48th state to adopt a similar change, where we'll impanel a board of directors of 5, all of whom must have substantial investment expertise, appointed by different pieces of government: the governor, the House, the Senate, the treasurer, and then the treasurer ex officio. to come together to share those fiduciary responsibilities to ensure that we have a long-term continuous approach. 6-year terms for each of the appointees, staggered board, all best-in-class governance reforms that we've learned by educating ourselves on the processes that other states have gone through. So moving on to Bitcoin, because I know this is topical, and certainly there's a bill in the House that authorizes some changes around what the Department of State Treasurer can do. So first question I always get is, what is Bitcoin? And what Bitcoin essentially is, you should think of it as, is a alternative currency. Bitcoin was born in the midst of the global financial crisis of 2009. And if you remember that time period, everybody lost trust in every financial institution. Some of them very much deserved us to lose their trust in, some less so. And so what the creators of Bitcoin were looking to do was to create a currency that couldn't be debased by some governmental entity, that just depended, and they call it trustless, on the architecture of the currency itself, rather than trusting some central authority. So it is a currency that exists in that way. It is very similar to gold. You might ask yourself, what is gold worth? And it trades every day if you want to buy and sell it. But what's the intrinsic value of gold? Nobody really has the answer to that question. And so it is with Bitcoin. You could think of it as value based on the power it takes to create it. You could think of it as value in what it trades at. There's many different ways to think about the value of Bitcoin. But there's no question that it is real. Bitcoin today is valued at about $1.6 trillion. And so the capitalization of the market and the institutional adoption of it tell you that it is a real thing that will be around. What the legislature is proposing is to allow the state treasurer, or ultimately the investment management authority, to buy Bitcoin directly. Bitcoin, though, exists indirectly already. If you own MicroStrategy stock, or you own GameStop stock, or you own Tesla stock, you own Bitcoin. There are also ETFs that hold Bitcoin. And so there's a lot of financial innovation that allows the Department of State Treasurer and the Investment Management Division to already participate in these markets, and we essentially don't. That's not to say we won't forever, though. These markets are evolving rapidly. Bitcoin is being used today really as a hedge against the value of the US dollar. What I know that most people believe, and is bipartisan in nature, is that Washington, D.C. has a budget problem. Whether you think that's a revenue problem or an expense problem depends on your political disposition, but I think everybody agrees that there's a math problem, that the government spends a lot more money than it has, the federal government, that is. So the question is, if you believe that and you want to hedge yourself against the dollar losing value, you have to buy something else. Traditionally, that would have been the euro or the yen or some other foreign currency, but all of those governments have similar problems. And so the answers in recent times have been gold and Bitcoin. And as that becomes more and more true, that Bitcoin acts as a hedge to the US dollar and a hedge against the fiscal profligacy that's going on in Washington, D.C., it becomes more interesting to us. And so stay tuned. The legislature is proposing a number of things which are options for us, not obligations. And I think that's important to know. But ultimately, I think Bitcoin is something that will end up in many institutional portfolios, just not today. So we administer benefits for a number of different pension and supplemental systems. There are 8 listed here. They have many different varieties, and many of you are members of one of these. We invest them jointly, though. They are all invested in the long-term pool and some in the short-term asset pool as well. So we got a question about turnaround time. And one of the things that I'm proud of our department for doing is being very clear with what we're trying to do. So if you go to the nctreasurer.com page, you will see an accountability metrics tab. And what we have there is each of our divisions listing out what it is they are trying to do from a headline metric perspective and how they are doing versus it. So in this case, we're looking at the death benefit for the retirement systems division and turnaround time. So our standard time is 30 to 60 days typically. This shows you where we were in 2024 by month. We do have some months that are in excess of that. Today, we are well in excess of this. That turnaround time is over 60 days, and it's something that we are working hard to make sure that we get back to where we want it to be, and that is sub 35 days. So we are aware of it. It is something that is front of mind, and we are going to report on it and have added some more resources to ensure that we get it back to where it needs to be. So I'm going to wrap up my comments there. I know I've thrown a lot at you. We have a number of people in the room with me. So if you ask a really hard question, I'm going to have to call in, phone a friend, so to speak. But we'd love to take any and all questions about all the different things that we do here. And I look forward to discussing whatever's on your mind.
All right. Thank you, Treasurer Briner. I'm going to paraphrase a couple here, and we're going to come out with a hot one, okay? So
All right.
just to start it off, I've got a question from Francis, and she's kind of asking about the current markets and how are you all handling it?
Sure. So the strategy of what we're doing on the investment side is a heck of a lot easier than the tactics right now. So we know that over time, we need to have more stocks in our portfolio. We have, when I started office, we were about 48% in stocks and 52% in bonds and the equivalents. Over time, we want to get that to be 65-35, maybe 60-40. And so going from 48 to 65 in stocks is, from a strategy perspective, quite clear that we need to do that. But to your question, the tactics of when do you do that? That's quite hard. As tariff policy unfolded in April, and we saw the market draw down dramatically, and then we saw the market rise dramatically in a day because it became clear that this was a negotiation and not a strategy to destroy the kind of global trade architecture. We got more comfortable buying into that dip. We invested over $2 billion in stocks in April. Before I walked in here, I signed a memo to sell most of those $2 billion worth of stocks, in part because they're up substantially, and we don't think that trade policy challenges have abated. So I recognize that's incredibly tactical, but there are a lot of uncertainties out there today. I think more interestingly for us and for many of the folks on this webinar, for the first time in 20 years, you're really getting paid interest. And that is a viable and attractive alternative to being very long in the stock market and taking all the volatility that comes with that. So we're being very cautious, judicious in getting to our tactical target or our strategic target over time, given all of the uncertainty out there. That said, I don't want that to come across as too pessimistic or negative. I think people forget, and they did in 2017 as well, that this administration is fundamentally business friendly. And that matters very much to the success of businesses over time. And so we don't want to lose sight of that either.
Okay, great. Good answer. Thank you. Question, and we've had a couple, especially on local government, so I appreciate you really addressing this, but maybe going a little bit deeper. Someone says, this is from Thomas. He says, I understand the current formula for computing local government increases based on the fund's earnings, but this needs to change and we need help now. So could you kind of speak to that, and in particular local government?
Yeah. The toughest phone calls I get in this job are often from local government employees who tell me about the cost of living adjustment pattern. And so I'm very aware of that. And that is a challenging conversation to have because the truth is the local governments have done a great job funding this system. And the retirees have not taken out of this system. It has been the investment side that has not enabled those cost of living adjustments. And so we will and are fixing that. That is not going to happen overnight. So that's the first thing I'll say. The second thing I'll say is that we're going to have what's called an experience review in the fall. What an experience review is unpacking all of the underlying assumptions that we make in managing the pension system to assure ourselves and everybody that those are still relevant. We have a pension debt in these systems. Anytime you're sub 100% funded, that's essentially a debt that we owe into the system to pay future benefits. And the question with many debts is how quickly do you pay them off? We have an extraordinarily aggressive, meaning short, payment schedule in our pension system right now. We're going to assess whether that remains appropriate, and that will change some of the funding calculations, potentially allowing us to get back to cost of living adjustments. That said, I don't want to make false promises here, and I don't want people to hear me inaccurately. At 87% funded, it would be tough for the Board of Trustees to recommend a COLA in the coming year. And so there's still work to do to make sure that we get these pension systems to the place they need to be before you would expect a permanent COLA to be authorized by the Board of Trustees.
Great, thank you. I've got a question from Leslie. And it's, how will the TSERS pension and health plan survive with the number of employees contributing dropping? Response.
Sure. So we anticipate that partly in the experience review. You look at how many employees you'll have and how long they'll be with you and how long they'll contribute and all the different factors that go into that. So the decline in the number of active employees relative to beneficiaries is not a surprise. That is something that we understand and knew was coming many years ago. So we've planned for that. What we don't plan for are big changes in that. So if, Elon Musk and Doge came to North Carolina and laid off a bunch of state employees, we wouldn't have planned for that. But the normal course of the changing dynamic of more retirees relative to actives is something that we are planned for already.
Great, great. And back to Elger's question, Kent is asking about the percentage of funding, but he was asking, what is the real dollar amount?
The real dollar amount. So I think about all of our pensions together when I answer that question. So we have about a $16 billion deficit in our aggregated pension system that we need to address.
Okay. And they're coming in quick now, so I'm trying to think about. Okay, and this is from Jessica. So she's thanking you for making an effort to keep the cost of the state health plan monthly premiums down for retirees. And she's asking a more specific question on the Medicare, and I'll probably let one of your staff pick that one up. And she said, overall, an excellent presentation, and thank you.
Thank you.
All right, let's see. This one, it's going back to the crypto questions, but there's a question about the 5%. And the question was asking, is it the same in both the House and Senate bill? Are both in agreement on the 5%?
I believe they are. Yes.
Okay, very good. Okay.
I just as an editorial comment, we don't own 5% of the pension system in any security other than U.S. Treasury bonds, and we wouldn't. As a matter of kind of fiduciary governance of the pension system and building institutional portfolios, that's far too concentrated a risk for a low risk, low return investor like a pension system. So I don't know where the original 10% came from or where the 5% comes from. That's for the authors of the bill to answer. And again, we appreciate the options that we are being given, but we would not put 5% in Microsoft stock, let alone Bitcoin or something else.
Okay, that's great. Thank you. I know a lot of folks have a lot of questions around that, especially just understanding what the concept is in general, but I appreciate you taking the time to answer those questions.
I mean, the interesting and ironic piece about the Bitcoin legislation is that since the day it was filed, Bitcoin is up over 40%. And so, you don't want to lose sight of the idea, at least part of the idea, is to improve pension returns. And that's a goal that we all share. Yeah.
Very good. All right, next question, and here's a bit of a get to put on your history hat. Has LGERs or TSERs ever been fully funded?
Yes, they have. And so if you go back into the 1990s, these plans were over 100% funded. And in fact, and Sam may correct me on some of this, but in fact, there was no employer contribution back then because they were over 100% funded. Part of the history of how we got to the portfolio structure we have comes out of that. When you have a 6.5% and at that point 7% actuarially assumed rate of return, and you have US Treasury bonds yielding more than that, putting your money in Treasury bonds and sleeping really well at night and making the pension system work is a very attractive alternative. And that's the one that North Carolina pursued back then largely, which was the right answer. I think what happened is interest rates fell dramatically. That causes your liabilities to get more expensive. That causes your assets in the form of Treasury bonds not to keep up in terms of prospective return. And so, if people really want to distill this, the challenge behind the way we manage the pension system is that we didn't react to materially falling interest rates.
Okay, that's great. I've got two more for you.
Sure.
And I'll start with one, and I think I know where your answer is going to go, but this is from David, and he says, "Could you say a bit more about how the legislature proposes to get to a place where COLA could be possible?"
So a handful of things. First, we're changing the investment governance, and we would expect that will manifest in higher investment returns over time. Second, we'll go through the experience review, which will allow us to think a little bit differently about the employer contribution. And those two factors put together will allow, I think, them to feel better about the future of our current liabilities before they add a cost of living adjustment on top of that. Again, I don't think that is next year's conversation. This is more of a medium-term conversation. But once you're on a good path of the employer contribution no longer going up, investment returns being delivered in the way that they need to be delivered, that's when the COLA conversation really comes to pass. I would watch the funding ratio of these pension systems, and I think it's very viable to have that conversation once those are in the 90s, and we're not that far from it.
Okay, that's great. Okay. Let's see. Oh, here's an interesting one. This is from Bob, and he's asking, "Are you engaging outside financial advisors as the previous treasurer removed?"
We are, but it's different. I think I get asked a slightly different variant of that question all the time, and that is, are we just going back to the way that things were managed 8 years ago from the investment perspective? And the answer to that is no. So it's neither Treasurer Falwell, nor Treasurer Cowles, nor Treasurer Moore, for that matter, nor Treasurer Boyle's investment strategy. The things that are our advantages, I think we need to extract more value from. The first is our scale. We're actually over $130 billion of total pension assets. That makes us one of the largest pension systems in the United States and the world. That commands the attention of high-performing investment firms and a negotiating position from a fees perspective that is unrivaled. And so we need to leverage that more fully. What that means is that we need to be more concentrated with individual managers. So if you give a manager $100 million, they give you a certain fee structure. If you make it 10 times that, they give you a better fee structure. And it's good for them and it's good for you. And so we're focused in part on economies of scale. The second thing that we're focused on is internal management. So one of the major initiatives under Treasurer Falwell, which was wonderful, was bringing in the internal management of equities. We've always had a fixed income desk in here as well. And we are moving more and more assets to internally managed, not just on the traditional equity and traditional fixed income side. We're expanding our capability in credit to below investment grade credit internally. And we're doing what's much more of direct and co-investing in the private markets. These are fee advantaged, but they also allow us to manage our liabilities or the money we promise people better, which should allow for better returns as well. So this is a playbook that is much more akin to what family offices and endowments do with much less risk than they take, of extracting economies of scale and ensuring a more direct management.
Excellent. That's great. I appreciate that. I've got one more from you from Neil. And this one, and I'll say to our members, we are supportive of the Investment Modernization Act. So we think it's kind of long overdue. So on that note, here's the question. This is about sort of the Investment Modernization Act. Does this create any negative issues for you and future treasurers? For example, what issue would arise if the treasurer does not approve of the investment strategy implemented by the committee? The treasurer is elected. How are the committee members held accountable?
They are all politically appointed ultimately by the governor, the House, the Senate, and the treasurer him or herself. So over time, the board rolls over. It is staggered, as I mentioned. One of the concerns that people have is decisiveness of boards versus individuals. And I think that is accurate, that boards take more time, are a little bit more deliberative, and do not react quite as quickly. That said, that is both a positive and a negative. And so the decision to sell is also one that is sometimes precipitously arrived at. I will tell you, in April, we had individual days where we lost more than $1 billion. And I've been doing this a long time, so that does not please me, but it does not faze me. And it doesn't cause me to go sell everything at the bottom. Individuals make that kind of decision. A board would never make that kind of decision. And so I think there are, of course, puts and takes to that, but in the fullness of time, having a disciplined, consistent investment strategy is the answer to the question that we're trying to solve for, and that's making 6.5% consistently.
Okay. Can I ask you one more? These are good ones. This is just great. These are great questions coming in. So this one's from Charlotte, and she's asking about how does the vacancy rate affect the pension?
So changes in the vacancy rate would affect the pension. I think I'm amazed, and I'm somewhat new to state government still. I'm amazed when people talk about the vacancy rate in isolation. What matters is the vacancy rate differences over time. So we plan for a certain amount of vacancy, and if it changes lower, that's more people paying into the pension system, but they're also accruing benefits likely. And if it goes higher, that's less people paying into the pension system, but they're also not accruing benefits. And so where the vacancy rate is today is low 20s and falling. And I think historically it was high teens. So you're not that far away from a normal level. When it was over 25 there for a minute, that's when I think it became challenging in terms of the cash flow in the short run.
Okay, that's great. Well, your staff, I'm watching, they're doing a great job online answering questions, and especially appreciate Beth is fast and furious here. I'll just let you know that on the health plan. So tell Beth thank you.
Thank you, Beth.
Okay, I got a couple more. If you don't mind, because these are the kind of questions people always ask me, and really they're getting it straight from you. So the question is, how many people do the governor, the legislature, and the treasurer appoint?
How many total?
Yes.
I can't speak for the governor and the legislature. We've got, I'm going to guess, 50 appointees around our boards.
Okay.
There are a number of boards, and some of them are really big lifts and some of them are very light lifts. My guess is the governor appoints 1,000. I mean, there's an extraordinary number of boards and commissions in the state.
Okay, that's great. Well, we have a ton more questions here, and just know we will share these with the treasurer and his staff offline, and they have promised to try to get answers to you as well. And then we will, if your question does not get answered, you can email Daryl, who I'm going to hand it over to, or me, and we will make sure we get it to the right person. If we can't answer it, we'll find somebody who can. So with that, Treasurer Briner, it has been such a pleasure to have you, and you're always so just informative, and we appreciate your transparency and the sincerity which you're approaching all the decisions that you're making.
Well, you're very kind. Thank you. I'd be remiss not to go on here for a second about the partnership we have with you guys. RGEA has been fantastic, informing us, keeping us informed of all the issues, helping us think through the solutions that we're proposing. And so it really is a two-way street here, and we appreciate all the work that you guys do in helping us get to better solutions for everybody in North Carolina. So thank you, guys.
Oh, thank you. Thank you. I'm going to let Daryl close us out here. And again, Daryl puts in just endless hours beyond, I would say, the call of duty to make these things come together. And just very appreciative for Daryl. So Daryl, go ahead and take it away and close us out.
All right. Thank you so very much. And thank you again, Treasurer Briner. And I also want to thank your team, because we worked tirelessly to help this happened today, and we really truly appreciate it. And Tim, I will take the questions and we'll pass them along so that you can get them to the right person. So thank you all, and thank you all the members for attending today. And I have a couple of housekeeping kinds of things to tell you. Before we leave, I want to let you know that there will be a survey. We will be sending it later this week. And again, it is quick and easy to complete, and we need to know your responses probably by Thursday or Friday. Before we leave, also note that the next Lunch and Learn webinar will be held on Monday, July 14th at 12:30 p.m. Entitled North Carolina Legislature and You. Know and Grow RGEA's Advocacy. That one also is on Monday, so please put that on your calendar, Monday, July 14th. There will be updates on the budget proposals related to your pensions benefits and well-being, and opportunities to practice grassroots advocacy. We will continue some of the conversations we've held today. So please plan to attend, and please again, place it on your calendar for Monday. Thanks again, all of you, for joining us. And as always, the association stands ready to assist you in your retirement. And I want to say happy Monday, stay safe, and enjoy your summer. And again, thank you, Treasurer Briner and your team.